All right, if you're prepping for your finance qualifying exams, you know Merton Miller's Debt and Taxes is a big one. It's a lot, but it's also absolutely brilliant. So today, we're going to break it down piece by piece so you can walk into that exam and just nail it. Okay, so let's jump right into the big puzzle that Miller was trying to figure out. See, the theories before this, including his own work, basically said that because interest payments are tax deductible, firms should be piling on as much debt as they possibly can. I mean, it's a massive tax advantage. But when you look out at the real world, companies just weren't doing that, not even close. So what gives? And here's what makes the mystery even deeper. From the 1920s to the 1950s, corporate tax rates in the US just exploded. They shot up 5 times over, going from around 10% to over 50%. The incentive to use debt should have been off the charts. And yet, corporate debt ratios barely moved. Something big was clearly missing from the picture. To get to the bottom of this, we're going to follow Miller's own logic. First, we'll lay out the puzzle. Then we'll look at the standard explanation and see why he thought it was, frankly, ridiculous. After that, we get to his big insight, adding personal taxes to the mix. We'll see how that changes the entire game at a market level, who really gets the benefits, and then we'll put it all together into the complete capital structure story. So, first things first, let's really dig into why this was even a puzzle to begin with. And it all goes back to the famous Modigliani-Miller theory, which, and this is the ironic part, created the very problem that Miller himself later had to solve. The logic from their earlier paper was so simple and powerful. It basically says the value of a leveraged company is its unleveraged value plus the present value of its tax shield. And since that tax shield just gets bigger and bigger with every dollar of debt you add, the formula is pretty much screaming at you. Take on more debt, maximize your value. So why on earth weren't managers listening? Now, the typical answer you've probably heard a million times is the trade-off theory. You know, the idea that firms are just balancing the tax benefits of debt against the potential costs of bankruptcy. But Miller looked at this and thought, no way. For him, these two things weren't even in the same weight class. And he just destroyed this idea with one of the most brilliant analogies in all of finance. Think about it. If you're making a stew and you put in one giant horse and one tiny little rabbit, what's it going to taste like? It's going to taste like horse. And Miller's point is that the tax benefit is the horse, and it completely overwhelms the tiny rabbit of bankruptcy costs. And he had the numbers to back it up. The horse, the tax saving was enormous. With corporate tax rates around 50%, every single dollar in interest paid out saved the company a full 50 cents in taxes. That is a direct, massive cash benefit. And the rabbit? The bankruptcy costs? Well, Miller pointed to studies of huge railroad bankruptcies that found the direct costs, lawyers, accountants, were just a tiny fraction of the firm's value. We're talking like 5%. The rabbit just isn't big enough to scare anyone away from the horse. So, if bankruptcy costs can't solve the puzzle, what can? Well, this is where Miller's genius really kicks in. He said, everyone's been looking in the wrong place. We're all obsessed with the corporation's taxes, but we're completely ignoring the taxes that the investors themselves have to pay. To get this right, he says we have to look at 3 different tax rates. First, you've got the corporate tax rate, what we'll call Tau C. But then, and this is the key, he adds 2 more. There's the personal tax rate on stock income, think capital gains, that's Tau PS. And then there's the personal tax rate on bond income, that's just regular interest income, which we'll call Tau PB. The whole game changes when you realize that these 2 personal rates aren't the same. Okay, just follow a single dollar of profit a company earns. If that dollar is headed to a stockholder, it gets hit with taxes twice. First, the corporation pays taxes on it, then the investor pays personal taxes on it as a dividend or capital gain. But if that exact same dollar is paid out as interest to a bondholder, it gets to skip the corporate tax step entirely. It only gets taxed once at the bondholder's personal rate. You see the difference? And this leads us to a new, much more complete formula for the gain from leverage. Now look, don't panic about memorizing this derivation for your exam, but you absolutely have to understand what this formula is doing. That big fraction in the middle, that's really a contest. It's comparing the after-tax cash an investor actually keeps depending on whether it came through the equity path or the debt path. So all of a sudden, this isn't just about corporate taxes. It's about how all 3 tax rates play together. And here it is, the big punchline. The entire gain from using debt can completely disappear.
It happens at this magical point where the personal tax disadvantage of holding bonds, which get taxed pretty heavily, perfectly cancels out the corporate tax advantage of issuing debt in the first place. The two forces balance and poof, the incentive to use debt is gone.
Now, hold on, because this is the real aha moment. Miller's next move was to take this idea about a single firm and blow it up to the scale of the entire economy. He said, you can't just think about one company. You have to think about the total supply and demand for corporate debt in the market. And this is where the theory becomes just beautiful. Okay, this next part might break your brain a little bit, because it turns basic Econ 101 on its head. Miller argues that the demand curve for corporate bonds actually slopes upward. Just think it through. Who's first in line to buy bonds? It's the tax-exempt investors, right? Pension funds, endowments. They don't pay personal taxes, so they'll take the lowest interest rate offered. But what happens when companies want to issue more debt? They've got to find new buyers. To get an investor in, say, a 15% tax bracket to buy, the company has to offer a higher interest rate to make it worth their while after taxes. To get a 30% tax bracket investor, the rate has to go even higher. So the more bonds supplied, the higher the price, the interest rate, has to be. That's an upward sloping demand curve. The supply side? Way simpler. From the company's point of view, as long as there's even a penny of tax advantage left on the table, they're going to keep issuing debt. They will supply bonds all the way up to that break-even point we just talked about, where the advantage hits zero. That creates a perfectly flat, horizontal supply curve for the market. So you put the two together. An upward sloping demand curve meets a flat supply curve. Where they cross is our market equilibrium. And this gives us two absolutely mind-bending results. First, on the big macro level, there is an optimal limited amount of debt for the whole economy. But second, down at the micro level of a single company, its capital structure is, once again, totally irrelevant. The market competes away the tax advantage for the very last firm, and we are right back where we started in 1958 with the irrelevance proposition. It's incredible. This equilibrium point also tells us some really cool things about who ends up owning what. The market just naturally sorts investors into different groups based on their tax situation, something Miller called clienteles. So the model predicts this really clean sorting effect. You've got your low tax or zero tax investors. Again, think pension funds, nonprofits. They become the natural owners of corporate bonds because they get to pocket that full high pre-tax interest rate. And then you have your high tax bracket individuals. They're going to stay away from bonds and will prefer to own stocks, since the returns from stocks are taxed more gently as capital gains. Everyone finds their preferred home. And this leads to maybe the wildest conclusion of all. Who actually gets the money from this famous corporate tax deduction? It's not the company's stockholders. In the end, the benefit gets competed away and passed entirely to the bondholders. Specifically, it goes to what are called the inframarginal bondholders. Those are all the investors, like those pension funds who bought early, whose personal tax bracket is lower than the corporate rate. They're earning a surplus, basically a gift from the US tax code. Okay, let's bring it all home and put the final story together. This three-step evolution is absolutely the key takeaway for your exam. If you get this, you get Miller 1977. It's really an intellectual journey that took almost 20 years. It starts in 1958. Modigliani and Miller say, in a perfect world with no taxes, capital structure is irrelevant. Then, in 1963, they add corporate taxes, and suddenly the theory says firms should be 100% debt. That creates the puzzle. And finally, in 1977, Miller adds personal taxes to the model, which solves the puzzle, and, in a stunning twist, brings the conclusion for the individual firm all the way back to irrelevance. And that leaves us with one last big question to chew on. Miller's theory is powerful, it's elegant, but if he's right, and a firm's mix of debt and equity is ultimately irrelevant to its value, why do real-world CFOs and finance teams spend countless hours worrying about exactly that? That's the puzzle this theory leaves us with.